Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our periodic commentary on financial markets and economic events. Let's get started. This episode of Market Insights is devoted to our 2022 financial market outlook. And I think we can best summarize that outlook by saying,
fasten your seatbelts. It's going to be a bumpy night.
We feel like markets are probably going to be a lot more volatile in 2022, and in particular segments of the market, there could be a lot of heartache. Now, to put that cautious and conservative call in context, we need to remind investors that we have been consistently bullish since March of 2020, nearly 2 years ago, when we wrote a piece called Modern Monetary Theory to the Rescue. And the premise of that piece and the premise behind our bullishness has been that the Federal Reserve was printing a tidal wave of new cash and pouring that liquidity into financial markets. And all of that incremental liquidity was a tailwind that would just keep pushing financial markets higher and higher. Well, in 2022, the Fed is going to be shutting down that money printing party. And based upon their most recent statements to financial markets, they're not just going to shut down their printing press. They're also going to raise interest rates. And it's important to understand that when the Fed says they're raising interest rates, how they make that happen is they effectively unprint money. They drain some of the money that they pushed into financial markets, they drain it back out. That's how they achieve higher interest rates. And so the big tailwind from the Federal Reserve for the last nearly 2 years is going to fade away, and then sometime in 2022 it's going to turn into a headwind as they raise rates and drain liquidity from financial markets. Now, to old investors like me, the 2022 market environment feels an awful lot like déjà vu. It feels almost like we're reliving the script from the year 2000. Why do I say that? Well, because in the year 2000, financial markets were extremely pricey. Valuations were at all-time records. And as a matter of fact, as we move into 2022, financial market valuations are the highest they have been since 2000. So we've got a very pricey, very expensive equity market. And in 2000, the Federal Reserve started running their money printing machine in reverse and draining money from the financial system. In 2000, the motivation was they'd printed a ton of money because they thought Y2K would disrupt the financial system. When nothing bad happened, they had to hoover all that money back out of the system. In 2022, the issue is inflation. They have printed a ton of money, and because of supply chain disruptions, because of COVID, there's not as much production, there's not as much supply of stuff. So you have too much money chasing too few goods, inflation. The Fed has to respond to that by trying to drain some of that money back out of financial markets. So 2000, expensive market, Fed is unprinting money. 2022, expensive financial market, and the Fed is unprinting money. And the similarities don't end there, because we're also seeing a big rollover in earnings growth in some of the hottest technology sectors, very similar to the environment that we saw in 2000. So earnings growth is also slowing. And that combination of events, if the past is prologue, if what we saw in 2000 plays out in 2022, then what we can expect is a relatively mild pullback in the overall equity market. In 2000, equity markets fell about 9%. Not terrible when you think about how far they had risen in the 3 years prior. All right? But that 9% fall in the overall market masks a lot of pain and suffering under the surface. Because as the Fed switched from pumping money into markets to pulling it back out, the parts of the market that fell the hardest were the parts of the market that had become the most overvalued as the Fed was pushing money into the market. Technology stocks, dot-com bubbles, that was the part of the market that didn't fall 9, it fell 50, 60, and some of those stocks fell 90% and haven't ever quite bounced back, right? Fast forward to now. There's a lot of speculation going on in very similar parts of the market, technology in particular, but also new types of speculative investments like Bitcoin. And we believe that as the Fed shuts down the printing press, just as we saw in 2000, those most speculative parts of the market will be where most of the pain and the suffering occurs. Is there a safe harbor? Well, in 2000, there definitely was. Low volatility stocks, dividend-oriented stocks, value-based stocks, they all dramatically outperformed the overall market. And the reason they did that is because despite the fact that the Fed was shutting down its printing press and pulling money out of the market, the overall economy was still in really good shape. So the market basically just turned its attention from the types of stocks that love it when the Fed's printing money to the types of stocks that continue to do well when the Fed is unprinting money, but the economy is strong. If we think that that's a similar environment to what we see in 2022, and we do, then we think next year, as we see corrections in the speculative, very overvalued parts of the market, we think you could see dramatic outperformance in low volatility, dividend-oriented stocks, and basic value-type names. The boring, unexciting stuff that no one has been interested in as they've been chasing Tesla and Bitcoin up 1,000%. But in a world where the Federal Reserve is no longer a steady, reliable source of newly printed money, we think those are the types of stocks that could really shine. Thanks for joining us for Market Insights. We hope you found it informative. If you did, we hope you could like the video and share it with your friends. If you'd like to see a more complete discussion of our 2022 outlook, you can find it on our website, caravelconcepts.com. Thanks.